I've been following markets for a long time, probably about 20 years of looking at markets on a day-to-day basis. And this is one of the worst technical environments that I've seen in a long time. Every time frame is pointing to the downside. So why is it that I'm hesitant to call a crash as the next move? Welcome to the Ready Set Trade Market Minute for Sunday, the 18th of September. First off, let's look at the technical picture of the S&P 500. On the left-hand side, I have the monthly chart. In the middle is the weekly, and on the right-hand side is the daily time frame. So all of these are now in downtrends. We have a lower high setting up on the monthly chart, which is a very, very dangerous technical signal. The last time that we truly saw one of these was back here in 2008. Look at this monthly lower high, and you can see the damage that this caused. There's untold number of charts that are out on Twitter that are showing the analog with today's market versus the 2008 analog, something that I talked about maybe 3 months ago in here and said, hey, this might happen. And now that everybody is talking about it, I'm starting to be a little bit suspect of this theory. The next thing that we see is on the weekly chart, we have a former uptrend transitioning back to a downtrend. And of course, that lower high is creating a monthly lower high. And then of course, we have on the daily chart, we already have a downtrend in play, which was confirmed once again on Thursday as it undercut the lows. Plus, we have the fib retracements that I talked about last week. From bottom to top, we have undercut that 61.8% level, which is that very, very important 3,900 level that I said that we must hold. Otherwise, the price is more than likely going to be at the very least retesting the June lows. The technical picture looks pretty ominous right now, no matter how we try to whitewash it. So everywhere I read on the internet, everybody is pointing to the downside. They're looking at the charts and they're rightly pointing at the downside saying, yep, here comes the crash. However, there's 3 data points I'm going to share with you here today that I view as contrarian. The first of these is the put-call ratio of equities and indices. And you can see that at this level here, the magic level is about 1.5. And once it gets up to about 1.5, this is where we've seen reversals. Right in the face of the worst fear and the worst sell-offs that we've seen over the past few years, we've seen these reversals kick in at about a put-call ratio of 1.5. So that is a contrarian bullish indicator. The next one that we have is the sentiment trader, smart money, dumb money confidence indicator. And you can see that right now the blue line is the smart money. This is actually much higher than the red line, which is the dumb money. And when we have a split of this size, what they're saying is this suggests an excess return of 3.1% over the next 2 months. That's not much. We can do 3% in a day these days in the S&P, but it still suggests a potential positive bullish divergence. And the very last one, of course, comes to you via our collective public meme, Jim Cramer, who recently said the easiest call in the world, the bear market isn't over. And Cramer has notoriously been used as a contrarian indicator lately with great success. So what do I think is going to happen this week? Well, all signs technically do point to at least a retest of the June lows, which is somewhere between 36 and 3,700 on the S&P. And the market may drift down to there before Wednesday's FOMC announcement at 2 p.m. and the press conference at 2:30 p.m. Eastern, which will put additional pressure on the Fed, not only monetarily, but also politically. If we see the Fed blink, if they show any openness to any kind of a pivot, which could be just slowing down their rate hike schedule into next year, I believe this would be viewed extremely positively that, okay, we're done. And the Fed's going to be done soon, or we know when the Fed's going to be done, and we'll see a very strong counter trend rally from that. If it's business as usual, then I expect us to be closing this week below the June lows. As you can see, this is a very, very important week, which will set the tone for the rest of this year and the beginning of 2023. That's it for today's Market Minute. We'll see you in the next one.